Want to get to our capital markets editor, Gary Kaminsky, with Charmaine Mosavar-Rahmani, the chief investment officer for Goldman Sachs Private Wealth Management. Hey, Gary.
Hey, Carl. Good morning. And yes, as we continue to try to talk to people who called it right last year, and as you mentioned, Charmaine, for viewers, within Goldman Sachs, there's a lot of different divisions. Charmaine is responsible for the high net worth division. So if you're a client in that division, this is a strategy and advice you're hearing for 2013. Good morning. Welcome, and good to see you again, Charmaine. Let's get right to the expected returns. I think we've got some charts here in terms of the various asset classes. And anything you want to highlight in terms of expected returns, what you're telling clients for the next 3 to 5 years?
In this environment, we're actually asking our clients to think about three things. First, we're going to have low interest rates for a while, and so they need to adjust their expected returns. So in a low interest rate environment, we're going to have lower returns across all asset classes. Second, we're telling our clients that as they think about the lower returns in the context of their portfolios, they also need to recognize that we are going to have volatility from incremental policy on a global basis, whether it's in the U.S., Europe, Japan, or emerging market countries. We are expecting that policy, whether it's monetary policy adjustments, fiscal policy, it will all be incremental, and that will create market pressures because it won't be at a pace that the markets would like to see. And so that will introduce volatility, and it's not something our clients should try to trade. They should look over the horizon and invest for the long run.
So looking at the long run, the 3 to 5 year term outlook, if you looked at those expected returns, it looks at what's interesting to me is that you think the Euro stock, certain areas of the Euro stock index, as well as the banks, the financial services companies, are where you can, if you're willing to accept some volatility, get the highest returns over that 5 year period. So the Euro stock, explain to us why you like that area for outsized returns.
So the context of investing in U.S. banks and the Euro Stoxx 50 is in a context of low returns across asset classes, but only for tactical recommendations. Our core assets should still stay in the U.S. So for core assets, U.S. equities, U.S. high yield are the best places to be. But at the margin, we like the returns in the low to mid-teens of European stocks and U.S. banks. With European stocks, our view is that they are trading at very cheap levels.
Right.
European stocks today in the Euro Stoxx 50, global multinationals, are at a 50% discount to the U.S. Typically, they trade at a 33% discount to the U.S. on average. So there's tremendous upside potential, and half the revenues of these global multinational companies come from outside of Europe. And so while they're getting tainted because of the European sovereign debt crisis, we actually think that they have very good upside. We've had this recommendation on for about a year, but we think that when we look at the next 5 years, we're looking at, let's say, 12 to 14% annual returns.
Now let's talk about the banks for a second, because obviously great performance last year by the financial services companies. You believe, like many, that the expectations are capital redeployed, dividends, distributions growth, companies being able once again to reward shareholders. Is that not priced into these financials, to these bank stocks right now?
So it's an interesting question regarding the fact that banks have done well, and we've actually had this recommendation on also for a while. However, we think there is still more to go. Banks are trading on average, we're talking about U.S. banks, at about 1 times book. Even if they were to have ROEs more in line of like utilities, 10 to 11%, we actually think they can trade at 1.4 times book easily. And so if you look at that over the next 3 to 5 years, again, you're talking about 14, 15% type returns. So we actually think there's still more upside. In addition to valuation, we think banks will benefit from the continued recovery in the housing sector. And we also think that as the stress test results come out again before the end of March, they will be able to do dividends and buybacks. And I don't think it's all priced in at this moment.
Let me ask you one philosophical question. Assume I'm a client of the bank, of Goldman Sachs, and like many people, I probably bought a lot of bonds because I was very concerned over the last 4 years about my own money, wanting capital preservation. And I look at the S&P, it's up 100% from the lows of 2008, 2009. And I say to myself, I know I'm too allocated right now in fixed income, but should I really be buying stocks at these levels? What do you tell me? What do the high net worth advisors tell the clients in a situation like that right now?
One of the most important things we have done this year for our clients is to show them 5-year numbers. And we're telling our clients that as they look, exactly as you say, look at bonds, look at equities, they need to look over the horizon for the next 5 years. And over the next 5 years, we expect basically zero returns on a nominal basis out of bonds, which actually means a negative real return. But when we're looking at equities, in spite of the tremendous run-up from the trough of the crisis, we are looking at 5 to 6% annual returns. And so we we encourage clients to think about that relative performance over the foreseeable future and slowly move out of their bonds into equities. We don't think there's great urgency to do that right away. They can do it in increments, but we think that that will be a very good long-term strategy.
Before we run, do you see clients actually making this tactical move right now?
More and more we're beginning to see people say, okay, well, the worst of the crisis seems over. Policy seems to be in a good place. We're seeing the economic recovery have some serious legs to it. Housing seems to have some serious legs. We can afford to take a bit more risk now.
Great. Thanks very much for joining us. And Carl, that's some actionable advice from Goldman Sachs, high net worth, for the retail clients viewing us. And by the way, both in terms of the Euro stocks as well as those bank stocks, there are ETFs, so you don't have to be individual stock pickers. Charmaine's work will tell you those sectors, if they're right in terms of absolute returns, significant outperformance in the years ahead.
I hope everybody was listening closely, Gary. Great stuff. Thank you.
Thanks.
And thanks, Charmaine.